India's 10-year bond yield is at 6.7%. This is the lowest we have seen it since September 2021, 3.5-year low. The immediate trigger, of course, is the record 2.7 trillion rupee dividend from the Reserve Bank to the government, which is the largest historically, even if it is a little lower than street expectations. On the other hand, against the bond yields is the US 10-year yield. They have touched 4.5% this morning after the court announcement setting aside the Trump tariffs, at least the reciprocal tariffs. The 30-year bond yield is at 5%, maybe even crossing the 5%, again, because of the court cancelling the Trump's reciprocal tariffs. The rise in US yields has led to foreign funds selling nearly $5 billion of Indian bonds in April and May. So what we are trying to understand today is where are Indian bond yields headed? There's a positive in terms of liquidity and a negative in terms of FPI sales. And what does all this mean to banks? I have with me Rikin, Shah, the Senior Vice President of IIFL Capital, to talk about this and about banks in particular. In a bit, we will be joined by Ashish Gupta to speak to us about bond markets. Rikin, first to you, because we have a big banking event on our hands. Before I come to bond yields, I wanted to ask you about your views on IndusInd Bank. With the latest salvo from the SEBI, you have not seen much of a change in the bank's prices, but how would you approach the bank?
Hi, morning, Latha. So, IndusInd Bank, we know that there have been multiple frauds that have kind of been communicated to the market in the last couple of months. While the interim order passed by the SEBI does on the insider trading does implicate the ex-MD and CEO, given that they are no longer part of the system, we have not seen the stock price getting impacted by that. But focusing on the fundamentals per se, I think the near-term fundamentals appear challenging for the stock. The growth is likely to be very subdued given the liquidity constraint that they will be grappling with. The incremental funds that they are raising, they are still at 50, 70 basis points higher than what the other peers are raising at, and hence the margins will remain under pressure. And the path to a normalized 1% ROA seems a bit long drawn from the current moment. But while this is the fundamental, I think the next couple of months, the focus is likely to be on the new CEO name, which would be first communicated to the RBI and then subsequently appointed and approved by the RBI. So that's where the near-term focus is likely to be. And post that, we expect the stock to start behaving more, looking at how the fundamentals trend.
But is the worst in the price with this negative news? Does it become a buy?
Given that the next 1 to 2 months, the news flow is likely to be a bit more positive vis-a-vis what we saw in the last 3, 4 months, do not expect a significant negative stock price action from the current levels. However, as I mentioned, post the CEO appointment happens, we expect the stock to start reflecting the fundamental trends, which we expect to be a bit more challenging still for the next 12 months.
Okay, now let me come to the overall banking space itself. We are seeing this fall in government bond yields. Wouldn't this be a challenge to banks in terms of their ability to, charge higher rates for, say, NBFCs or for any corporate, even for MSMEs? So do you expect, therefore, bank margins to be under pressure because of the fall in yields and because of the expected rate cuts?
Sure, Lata. So, we wrote a report recently where we said that the banking sector as a whole is ripe for a near-term breather. The essential argument underpinning this call is that given the rate cuts that we are likely to see, 50 bips have already happened, and the house view is that at least another 50 basis point will happen in this calendar year. The margins are likely to be under meaningful pressure. So we are expecting the margins to go down by 20-25 basis points in the next 3 quarters and subsequently recoup or stabilize thereafter from 4Q or FY27 onwards. The typical margin sensitivity says that for a 25 basis point of rate cut, you see margin pressures of around 5-7 basis point. And while the liquidity has improved and the cost of deposits, both on the savings account, time deposit, as well as the bulk account is going down, the full transmission of that will take a few quarters to play out. And hence, we expect significant margin pressure for the large private banks in the near term, followed by the PSU banks. And the least impacted should be the mid-sized private banks who have higher share of fixed rate loans and hence lesser margin pressure vis-a-vis the other two categories.
Okay, got that. I'm just coming to you in a minute in terms of more nuances for banks. But let me invite Ashish Gupta, the Chief Investment Officer of Axis Mutual Fund, into the conversation. Good morning, Ashish. Thank you again for your time.
Good morning.
Well, I began by, triumphantly announcing that bond yields at 6.17% are a 3.5-year low. And this is even without the Reserve Bank rate cut. If the rate cut were to come, and given the liquidity, it looks like the call market will go even below the 5.75% that it now is. So, what is your view on US 10-year, on India 10-year yields and on the call yields over, say, the next 6 months?
No, I think I agree with you that RBI has taken significant steps, both in terms of the rate cuts they have done, but more importantly, the liquidity infusion that they have provided. And at the lower end, therefore, the effective easing is also not just the rate cut, but the corridor that has opened up between repo and the STF rate of 50 basis points. So I think the flow for the short-term rates is falling much more, almost about 50 basis points higher than the cut in rates. On the long end, on the 10-year, I think given the drop that we have already had, I think market is built in to a significant extent the rate cuts that are coming. We believe a large part of the 10-year rally is actually behind us. And what we will probably see is more steepening of the curve rather than a parallel shift down in the curve. So we actually expect the shorter rates to fall more than at the longer end, because at the long end, a lot of rate cuts have actually already been priced in.
Okay, so by the end, just to get an idea of how far the rate cuts and the liquidity can go, the government hasn't spent the money, the nearly 3 trillion rupees. That also will come into the banking system. Yeah. And looks like we have a much more bountiful monsoon than we expected, say, a couple of weeks ago. So are you looking at a 5-quarter repo? Can repo rate cut go that far? And therefore, can call rate go even to 5%?
So our view is actually rate cuts to be about 25 to 50 basis points from here. I know there are forecasts in the market that are calling for even larger rate cuts of about 75 basis points or so. But we have to be mindful that in addition to domestic factors, we have to be cognizant of how rates are globally. And globally, unfortunately, rates have not been coming down. And actually, if you see in the last 9 months, most major markets, whether you look at US, Germany, Japan, even Brazil, bond yields are up between 50 to 150 basis points, while in India, as we talked about earlier, at the long end, bond yields have come down by about 70 basis points. Having said that, as of now, the higher global bond yields is not really curtailing the room for the RBI, because the dollar index has actually been weakening despite rising yields. And that allows RBI to conduct its monetary policy looking at domestic inflation.
1 minute, Ashish. 1 minute, Ashish. We have seen $5 billion move out of Indian bonds in April and May. At some point, this might accelerate even more. We got, 40 billion, 20 billion in the last several months, in the last 18 months or so. if there is a very big legging out, do you think that caps the Reserve Bank's both liquidity and interest rate elbow room?
So actually, foreign ownership of the Indian bond market is not very material, right? Actually, foreign ownership in India is much more in the equity markets, both in the FII and FDI route. The good news is that over the last month and a half, we have seen foreign portfolio flows turning positive. And if you see, therefore, RBI has, despite the $5 billion of bond outflow that you mentioned, we have actually seen forex reserves again started getting accumulated. And we are again moving close to nearly $700 billion of forex reserve. So I think given that construct, RBI still has the elbow room to pursue its independent monetary policy. But I think it will also make them a bit more conservative on how aggressively they want to take down rates.
Okay. Well, very quickly then, what's your view on, which is what I was discussing with Rikin, do you expect bank margins to take a fairly severe hit, considering that, the actual rates are lower than what the 10-year is indicating?
So I think, as Rikin also mentioned, there's no doubt bank margins will be under pressure. I think, having said that, the easing monetary policy was always expected to pull down bank margins. What has been a positive surprise over the last month is that banks have actually been willing to take a cut, particularly the private banks, in their savings deposit rate. And that actually protects the margins much more compared to really the pace at which you take down the term deposit rates, because the repricing is immediate. I think what, in terms of stocks, will be an equally important indicator is how does credit growth respond to these lower rates and better liquidity. Because if you see last 2 years, even though bank margins were very strong and among the highest that they have had, the stocks had not done anything till about 6 months ago because credit growth outlook was weakening. And I think it will be a positive for the banks if on back of this surplus liquidity, sharp cut in interest rate, you see a rebound in loan growth. And if, say, we can go back from 10, 11% loan growth to 15, 16% loan growth, I think investors should be quite happy with that.
Well, at least there are two problems for that. The last IIP number we got is an 8-month low. The number that we got yesterday. It doesn't look like credit growth is really picking up. Rikin, your thoughts? Actually, two quick questions because we have to wind up out of time. What do you expect in terms of credit growth? It's not just margins, but looks like even credit growth is not very good. And therefore, the second question separately, should we stop looking at margins and start looking only at ROA when we pick banks?
Sure. So, in terms of the credit growth, the long 10, 20-year CAGR of banking system loan growth has typically been around 10, 11%. But what we had seen in the last couple of years, the system loan growth had accelerated to almost 16%. Now, since then, it has been steadily decelerating. And the latest fortnightly print shows that the banking system loan growth is down to around 10% YOY right now. And we expect this banking system loan growth to slightly pick up from current 10% level. But the view is that it's unlikely that it will go back to 15, 16%. The inherent reason for this softness in the credit growth in our view is twofold. First one is that the corporate capex cycle, first, it's not significantly or cyclically turning up. And whatever the funding requirement of corporates is largely being catered to by the bond market, ECBs, and to some extent some NBFCs. So the large banks have actually lost 25 percentage point of market share in the last decade. So the corporate demand and corporate loan growth is not coming. On the other hand, we have seen that some of the larger retail loan segments like housing loan, etc., we have done a study which shows that whenever the rates are cut, the loan growth in lower yielding segments like home loan also decelerate. So these are the two drags. On the other hand, we expect some pickup in the unsecured loan growth following the significant slowdown in last 1.5 years, and some MSME growth to be there. So from 10%, it can go up to 12%, but unlikely to go back to 15, 16%. And margin, as we discussed earlier, is more of a cyclical pressure. We expect all of the margins that are being lost in this year to be recouped back in FY27. But ROA in FY26 is likely to go down by anywhere between 10 to 20 basis points. So investors will have to see through this cyclical pain and focus more on FY27 to be invested in the banks.
Okay. Actually, completely out of time. A one-line answer from you, Ashish. Would you also be as bearish on banks as Rikin is? ROA under pressure this year?
I agree with Rikin that ROA will be under pressure this year. I think ROAs will certainly come off from the highs of last year. But as he also mentioned, if we kind of take a more medium-term 2-3 year outlook, I think banks are still kind of quite comfortable.
Okay. Okay. Well, the audio is not obliging. Thank you very much, Ashish and Rikin. Get your point that there is possibly a cyclical low in terms of investor attraction for banks because of the lower ROAs, but medium term, it should be fine. We wrap up on Bazaar on that note. Chartbusters coming.